Imagine your annual dividends growing by over 60% in just 5 years. That's not a guess. That's what SCHD's dividend growth history has actually shown, with an average annual increase of 11.5% since inception. Ever wondered what just 100 shares could earn you each year right now? With today's yield above 4.1%, the answer might surprise you. First, we'll see why owning 100 shares is a clear goal. Then, we'll uncover how reinvested dividends can snowball and how monthly contributions speed up the results. If you're looking for a practical, achievable way to start building wealth, let's take a closer look. Setting a clear, actionable goal is one of the most effective ways to make progress in investing. And that's exactly what owning 100 shares of SCHD offers. Instead of chasing vague milestones or feeling overwhelmed by the idea of building a large portfolio, this target is both practical and motivating. You know exactly what you're working towards, and you can track your progress with every new share you add. For new and intermediate investors, this kind of clarity can make the difference between getting started and staying on the sidelines. SCHD's accessibility is a big part of its appeal. While some ETFs or individual stocks require a hefty initial outlay, SCHD trades at a valuation that's about 1/3 cheaper than the S&P 500, with a price-to-earnings ratio of 17 compared to the S&P's 26. That means you're not just buying into a fund with a solid track record, you're also getting in at a reasonable price relative to its earnings. This margin of safety is important for anyone who wants to minimize risk while building wealth over time. Let's talk numbers. With 100 shares, you're looking at an investment of roughly $7,000 based on recent market levels. That might sound like a lot, but it's a manageable goal for many investors, especially if you break it down into smaller steps. For example, you could aim to buy 10 shares at a time, or set up automatic monthly investments of $100 to $500. Many people find success by redirecting funds from less productive accounts, or by making small adjustments to their monthly spending. The point isn't to come up with the full amount overnight. It's about setting a target and consistently working towards it. Once you reach that 100 share milestone, the benefits become immediately tangible. At today's yield of just over 4.1%, those shares generate about $287 in annual dividends. That's money you receive simply for holding SCHD in your portfolio. No need to sell, no need to time the market, and unlike a typical savings account where interest rates rarely keep pace with inflation, SCHD's dividend income has a history of growing at a much faster clip. Since 2018, SCHD has raised its dividend payout at an impressive 13% annualized rate. That means your $287 in dividends isn't likely to stay flat. If history is any guide, it could raise significantly in the years ahead. Another advantage is the peace of mind that comes from owning a fund with a proven track record. SCHD focuses on high-quality, dividend-paying companies, and its selection process emphasizes financial strength and stability. This adds a layer of reliability that can be hard to find in individual stocks, especially during periods of market uncertainty. When you combine this with the ETF's attractive valuation, you're getting both growth potential and a measure of protection against overpaying. Breaking your goal into smaller, manageable steps can also help you stay motivated. Whether you're buying a few shares each month or taking advantage of market dips to add to your position, each purchase brings you closer to that 100 share mark. It's a strategy that rewards discipline and consistency, and it helps you develop the habits that lead to long-term success as an investor. Reaching 100 shares isn't just about hitting a number, it's about laying a foundation. Those shares provide you with a growing stream of passive income, and they serve as a base for future growth. The experience of watching dividends hit your account, seeing your balance grow, and knowing that your money is working for you can be incredibly motivating. It's proof that smart, steady investing really does pay off. But the real power of this approach comes when you take it a step further. Instead of simply collecting those dividends, what happens if you put them back to work? Next, let's see how reinvesting that $287 can turn into a powerful compounding engine. That $287 you earn today buys nearly 4 more shares of SCHD, which earns dividends too. So your payout grows every quarter. This is the essence of dividend reinvestment, and it's one of the most effective strategies for building wealth steadily over time. Instead of spending your dividend payouts or letting them sit idle, you automatically reinvest them right back into SCHD. This approach is called a dividend reinvestment plan, or DRIP. It's simple, hands-off, and incredibly powerful because every new share you buy with dividends starts generating its own income, creating a cycle of growth that accelerates with each passing year. Let's put this into perspective. With 100 shares of SCHD, your annual dividend payout at today's yield is about $287. If you reinvest that, you're not just adding to your share count, you're setting up those new shares to pay you even more next year. And here's where SCHD stands out. Since its inception, the fund's dividends have grown by 11.5% per year on average, and that rate jumps to 13% annually since 2018. So the $287 you earn this year could become over $320 next year, and the cycle continues, each time at a higher base. The real impact of a DRIP comes into focus over a few years. After 5 years of reinvesting, your annual dividend income could rise to more than $450, even if you never buy another share out of pocket. That's a 60% increase, powered entirely by dividend growth and compounding. Stretch this out over 10 years and your annual dividend income could surpass $800, all from your original 100 shares and reinvestment payouts. This kind of growth isn't just theoretical. It's grounded in SCHD's actual track record. What's important to understand is that this growth happens automatically. Once you set up dividend reinvestment, you don't have to think about timing the market or making complex decisions. Every quarter, your dividends go right back into buying more SCHD, and those new shares immediately start earning dividends of their own. Over time, the cycle accelerates. Even modest reinvestment can create a dividend stream you might use by your 30s or 40s, putting early financial independence within reach. Many investors underestimate the power of compounding because the numbers start small, but the snowball effect is real. The more shares you own, the more dividends you receive, and the more shares you can buy. This feedback loop is what makes dividend reinvestment such a powerful engine for long-term wealth. And with SCHD's consistent dividend growth, you're not just relying on price appreciation. You're building a growing income stream that can weather different market cycles. Another key advantage is reliability. SCHD focuses on companies with strong cash flows and solid financials, which supports its ability to keep raising dividends. Even during market downturns, the fund's income stream has proven resilient, giving you steady opportunities to reinvest and grow your holdings. Plus, SCHD's low expense ratio means more of your returns stay in your pocket, making every reinvested dollar count. Let's say you're aiming for financial freedom. By reinvesting dividends, you're not just growing your account balance, you're building an income stream that gets stronger every year. Over time, this can cover more of your expenses and give you options, whether it's retiring early or simply having more flexibility in your life. And it doesn't require huge sums to get started. The key is consistency and patience. Reinvesting dividends is a straightforward, proven way to turn a modest investment into a powerful wealth-building machine. But what if you could speed things up even more? That's where adding small, regular contributions can make an even bigger impact. Pairing monthly $500 contributions with dividend reinvesting can cut years off your timeline to financial freedom. This approach isn't about waiting for the perfect moment or trying to time the market. Instead, it's about using the power of consistency, making regular, manageable investments that stack up over time. Many investors underestimate how quickly small, steady contributions can accelerate their progress. But the math is clear. Combining disciplined monthly additions with reinvested dividends creates a powerful compounding effect. Let's break down what this looks like in practice. Suppose you start with 100 shares of SCHD, which currently generate about $287 per year in dividends at a 4.1% yield. By adding $500 each month, you're not just increasing your share count, you're also boosting the size of every future dividend payment. Based on conservative dividend growth and reinvestment, the research estimates you could reach $40,000 in annual dividends in about 19 years with $500 monthly additions. That's a realistic timeline for replacing a full-time salary, and it happens without making overly aggressive assumptions about market returns or dividend hikes. If you're able to contribute more, the results come even faster. Increasing your monthly additions to $750 could shave 4 or 5 years off that timeline. Pushing it up to $1,000 per month could get you there 7 or 8 years sooner. This flexibility lets you tailor your investment plan to your own goals and financial situation. The more you can put in consistently, the more dramatic the results, without needing to take on extra risk. The mechanics of this strategy are straightforward but powerful. Every $500 contribution buys more SCHD shares, which immediately start earning dividends. Those dividends are automatically reinvested, buying even more shares. Over time, this cycle builds momentum. Each new share adds to your income stream, and each payout increases the next round of reinvestment. The effect compounds quarter after quarter, year after year. One of the reasons this works so well with SCHD is its low expense ratio. At just 0.06%, you're only paying $6 per year on every $10,000 invested. That means more of your money stays in your account, compounding alongside your contributions and dividends. SCHD's 0.06% fee and built-in dollar cost averaging protect and boost each contribution. When you invest a fixed amount every month, you naturally buy more shares when prices are lower and fewer when prices are higher, averaging out your cost and reducing the impact of market swings. Another important factor is the tax advantage you get by holding SCHD in a Roth IRA. All your gains, including those growing dividend payouts, can be tax-free in retirement. Imagine reaching retirement age and collecting $1,500 a month in dividend income with no tax bill due. The Roth IRA structure lets your compounding engine run at full speed without taxes slowing it down. For long-term investors, this is a simple but powerful way to maximize every dollar you put to work. It's easy to overlook the impact of small, steady investments, but over years and decades, they're what make the difference between slow growth and real wealth. The combination of monthly contributions, reinvested dividends, low fees, and tax advantages create a system that multiplies your efforts. Each part of the strategy reinforces the others, making your path to financial independence smoother and more predictable. Want to know how SCHD holds up when the markets tank? Stay tuned. Up next, why this ETF is built to weather downturns. Long-term stability isn't just a bonus, it's a core feature of SCHD's design. This ETF is structured to hold up when markets get rough, offering investors a sense of security that's hard to find with more speculative funds. SCHD's approach centers on quality. It invests in companies with strong fundamentals, like robust cash flow, high return on equity, and a reliable record of paying dividends. These dividend champions, Coca-Cola, PepsiCo, and Texas Instruments, have weathered cycles and still grow payouts. Instead of chasing hype, SCHD sticks with businesses that have proven they can deliver steady results across different market environments. A big part of SCHD's stability comes from how it spreads its bets. About 30% of its portfolio sits in defensive sectors like healthcare and consumer staples. These industries provide products and services people use no matter what's happening in the economy. Think groceries, medicine, and household goods. That means even when markets are volatile or the economy slows down, these companies tend to keep earning and paying dividends. This allocation acts as a shock absorber, helping SCHD avoid the wild swings you might see in funds loaded with tech or speculative growth stocks. The numbers back up this defensive posture. During a recent market correction, SCHD's worst downdraw was about 21.5%, while a tech-heavy ETF like QQQ dropped 32%. That's a real-world example of how SCHD can help preserve capital when other parts of the market are hit harder. For investors, limiting losses during downturns is key because it shortens the road to recovery once markets improve. It's not about avoiding every dip, but about making sure your portfolio can bounce back faster. SCHD's focus on value also adds another layer of protection. Right now, SCHD trades at 17 times earnings versus the S&P 500's 26, offering a margin of safety that lowers downside risk. Paying less for each dollar of earnings means you're not overextending yourself in overheated markets. This discount doesn't just help during corrections, it also gives you more room for capital appreciation as the market eventually recognizes the value of these solid companies. When you combine this with a yield above 4%, you're getting both income and a cushion against volatility. Cost efficiency is another strength that shouldn't be overlooked. SCHD charges just 0.06% in annual fees, so more of your investment stays put and compounds over time. High-fee funds can chip away at returns, especially over decades, but SCHD's low expense ratio helps protect your gains, even in years when market performance is more modest. This, paired with its value focus, makes SCHD a practical choice for building wealth steadily. What sets SCHD apart isn't just its ability to generate income, it's the way it balances growth and protection. The fund's holdings are positioned to deliver not only reliable dividends, but also the potential for share price appreciation. This dual approach is especially important for long-term investors who want to reinvest dividends or rely on them for living expenses. SCHD doesn't force you to choose between safety and growth. It aims to provide both. All these features add up to an ETF that's built for the long haul. SCHD is designed to be a steady engine in your portfolio, delivering consistent income while managing risk. It's not about chasing the biggest gains in the shortest time, but about stacking up small, reliable wins that compound year after year. For anyone looking to build a resilient foundation for financial independence, SCHD offers a compelling blueprint. Now that we've seen SCHD defense strategy, let's pull it all together and decide if 100 shares today could be your smartest move this year. Looking at the numbers, a $10,000 stake in SCHD today could yield a 6.6% return on your original cost in 5 years and cross 10% in 10, all tax-free if you use a Roth IRA. That's a straightforward path to building a growing income stream while keeping more of what you earn. If you're ready to start your 100-share journey, comment your timeline below and hit like if this gave you clarity. Subscribe for more no-fluff, action-oriented investing insights, and let's build wealth together.